Great. Thank you so much, Mauricio. It is a pleasure to be here. And I should say that the last meeting I had at the FSB was kindly held in Santiago. It was a very successful meeting, and I have fond memories of the professionalism and the warmth of the people there. So thanks very much for having me back, if only virtually at this point. Am I able to share my point? Would that be okay?
Yes, you are.
Okay, so let me share my screen. Are you able now to see my presentation?
Yes.
Wonderful. So I know I have a hard 10-minute stop. So
Robert, given that Johannes didn't use all his 10 minutes, you're free to use his extra slack, please.
Wonderful. Thank you so much. So I'm going to focus on ESG investing and climate transition. The nature of the work we're doing this with central banks and finance ministries on our committee. It is not truly focused on financial stability per se, but more broadly about how markets and financial systems can help align their activities with climate transition toward low carbon economies. Now, we approached this effort in the sense that we're basically trying to ask, what is the use of ESG and other climate frameworks to try and facilitate this transition? And we note, of course, that ESG is there as well. We have to acknowledge, BlackRock and others, they use it primarily for long-term value, and that's financial materiality, but of course also other factors such as environmental and social factors that have an impact on that return. And then the second issue is about the growing consideration of ESG to help green the financial system and how it helps to lower the carbon footprint of investments. Now, this is also really a euphemism for the fact that many central banks are part of NGFS, and they're committing to greening of the financial system so that the financial system in turn can green our economies, industry by industry. And the questions are these tools, including ESG, which is really important for this discussion today, are they doing what they claim to do? Are they achieving long-term value? Are they aligning sustainability goals? And are they fit for purpose for greening of the financial system to achieve an orderly climate transition? So we undertook several types of analysis. This seems to be, here we are, okay. So what we're finding is, of course, I do want to say it's very important that this adoption takes place. So we appreciate there's a lot of growth of ESG, and in major markets around the world now, on stock exchanges, about 80% of the assets under management on the exchange are run in some way through an ESG approach. Over 40 trillion of assets under management from institutional investors, and a growing number of exchanges are recommending guidance, whether it's voluntary or mandatory, on ESG. But the challenges are there's wide variance in the use of ESG metrics and weightings to arrive at scores. And this creates a lot of confusion. And there's multiple materiality concepts and standards, whether it's financial or societal or sustainability, low correlation of ESG scores, and little relationship between high ESG tilted portfolios and risk-adjusted returns. So I want to show you a few charts that come from various publications we've done over the past 2 years. The first, I think it's pretty well known now on the left-hand side, there's a lack of correlation among ESG scores across the leading rating providers. This is not really inherently a problem. We want diversity of approaches and methodologies. The challenge here is it's very difficult to understand why. If you're looking at an individual company and one prominent rater says it's high ESG and another says it's low ESG, and you think ESG has some sort of meaning about sustainability, it's really hard for you to construct a high ESG portfolio. It really depends on the rating provider you use or your own methodology. And that is really a work in progress. And then on the right-hand side, we're just trying to show you some CAPM approaches where we're basically showing that, ESG, and we've done a range of assessments on ESG risk-adjusted returns using Sharpe, Trainer, other approaches. And what we're finding is that it's really mixed. ESG tends not to overperform, tends not to underperform. Sometimes it has a bit more volatility. That's neither good nor bad, but what we were trying to do was to challenge the view from many market participants that ESG can actually lead to outperforming. We haven't seen any evidence of that. The second question that is moving the financial materiality aside, does it actually align with sustainability goals? Do we see evidence of that? And given that central banks really are interested a lot in climate and alignment with net zero, our question was, Does it align, do ESG scores align in any way with CO2 emissions or CO2 intensity, carbon intensity, which is in this case emissions over revenue? And what we're finding is that it tends to be in some cases that emissions, the more a firm has a carbon footprint, the better its E-score. And also in some cases you're seeing with carbon intensity, there's no clear correlation. So for us, that was a bit concerning. Of course, we understand the E-score is an amalgamation of many factors, but for institutional investors or policy-oriented institutions like central banks that want to align their actions and portfolios and supervision, et cetera, with it, then the E-score of the ESG really raises concerns to us at this present time. And then what are the implications for institutional investors for portfolios? So what we found too, if one uses the E-scores of these major rating providers and you create your own stylized portfolio where you're tilting your portfolio toward high E-scores and away from low E-scores, what we're finding here is that in some cases, you will find that your portfolio actually has a higher carbon footprint by using ESG than not. Now, the feedback, of course, you'll have some people say, well, but that's not a problem because what we want to do is help facilitate that transition. And if we need to weigh more toward high carbon emitting companies, but they're promising to transition, then we're doing our part. And I guess our question is, okay, yes, if you look at some of the data within the E-score, you can see that that may not be the case. But what I guess our problem is that if the metrics don't consistently align, and many drivers of the E relate merely to the act of disclosure, so you see on the bottom chart here, climate change risk and opportunities, the more the firm communicates and discloses that it acknowledges that climate change exists and it's a problem and the firm commits to trying to do something to adapt or to mitigate, the better their E-score. The challenge is, that's great, but turning the promise into reality, the challenge is to make sure that those firms actually over many years are actually doing what they say they're doing in their plan. And therefore the plans don't yet contain enough forward-looking metrics to judge the transition, and there's a lack of near-term commitment and verifiable interim targets. And that's being much better understood over the past year, that we need more monitoring, more surveillance, and more review. So some of the recommendations that we've provided to the G20 Sustainable Task Force have included the ensuring of global consistency, comparability, and quality of core ESG metrics, promoting transparency and comparability of scoring methodologies. We appreciate diversity, but you have to be able to compare the methodologies. They need to be transparent, they need to be clear in how they're done, so you understand why the ratings are the way they are. And then improve relevance and precision of the E-score metrics through standalone submetrics. What we're basically saying is, while the E represents many factors, there should be a submetric. So if a central bank or an institutional investor cares about the climate transition, that there are metrics available within the ESG that make it very clear how that company ranks in terms of their progress. And then in terms of markets and climate transition, greater use of granular forward-looking climate transition disclosure metrics, and greater commitment to the use of science-based targets, so we know that these the climate plans are legitimate, are fact-based, are science-based, and that we can rely on them. So if the company says they're meeting these targets, it actually really is having an impact on lowering emissions. And then improving transparency and clarity of institutional investors' own stewardship plans to incentivize commitments to net zero pathway. And that's really important because we're really now relying on institutional investors to hold the companies accountable for their plans. And if institutional investors engage, but they don't actually take actions in terms of their portfolio, then it won't affect the pricing in the markets. And we think pricing is such an important signal to make sure if companies consistently are not abiding by their own plans to achieve net zero, that should affect their cost of capital and access to capital over time. We want to reward good behavior and obviously have a detrimental effect to those companies that don't stick to their plans. So overall, we're very pleased with the G20 process this year. We're contributing to G20, to APEC, to FSB, and to NGFS. in terms of our analysis and trying to make progress, like all of you, to make sure that the policies really align financial markets to try and achieve net zero over the years to come. Why don't I leave it there? Thank you.